Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, November 1st, 2022, starting with our economic release spotlight. So, the latest batch of key high frequency data from across the globe gave us incremental confidence in several themes we've been promoting in our research of late. Number one is pretty obvious global growth is continuing to slow. Not so obvious, or maybe not so obvious, is that it continues to be led down by the manufacturing sector, which is the sort of sector of the economy alongside housing, which is included in the manufacturing sector, it's much more cyclical relative to services, which is generally speaking for most advanced economies, anywhere between 70 to 90% of GDP, 60 to 70% of total employment. So just be aware of that. But anyway, global growth continues to slow. It's led down by the goods sector, and the U.S. continues to outperform most economies. Asia is outperforming Europe, and Europe is very much bringing up the rear. So just highlighting the first batch of final manufacturing PMI data we got for the month of October. India is accelerating, above 50 and accelerating in this characterization. India above 50 and decelerating is Australia, Indonesia, Japan, Ireland, Russia, and Switzerland. Below 50 and accelerating is Korea and China's unofficial Caixin manufacturing PMI index. We saw yesterday or over the weekend, the official manufacturing and services PMI index has actually ticked down pretty sharply. And then lastly, below 50 and decelerating. Again, for those of you who are new to PMIs, the 50 is the demarcation line. It's generally believed that the sector is slowing or contracting below 50 and expanding or growing above 50. And so below 50 and decelerating is the Netherlands, Greece, and UK. Tomorrow we'll get the rest of the Eurozone PMI figures as indicated by the preliminary results that we got a couple weeks ago. It's very likely we're going to see most of those countries below 50 and decelerating. This is one more thing I call out is that we saw a pretty sharp slowing of Korean exports, down 840 basis points to minus 5.7% year over year in October. That's the lowest print we've seen since August of 2020. That does imply some of the weakness we saw out of big tech fundamentals in Q3 likely continue to start Q4. And oh, by the way, it's probably going to continue beyond Q4 as well. Getting into my longboat dashboard, we'll start with global macro here this morning. Just one macro observation. There's not a lot of stuff that's overbought, oversold when you go down this range view. So dollar's kind of in the middle of range, gold's in the middle of range, 10-year middle of range, S&P, VIX, NASDAQ, Russell 2000, Bitcoin, Ethereum, Shanghai Composite, WTI, NAG. Industrial metals is getting close, but still no cigar on the oversold signal there. So definitely calling that out. One thing I would also call out, you have some bullish short-term momentum, obviously, in the S&P, Russell 2000, Bitcoin, Ethereum, WTI crude oil. To me, this is the number one story that I don't hear enough people speaking about in terms of the resurgence in crude oil. If we start to see medium-term positive price momentum in crude oil, while the president is still continuing to lean on the SPR, it's very likely that we're going to start to see some material rises in inflation expectations. We've already seen a material rise in inflation expectations, by the way. If you look at 10-year break-evens, they're actually up 36 basis points month over month to 2.51%. You look at 10-year inflation swap rates, which we like to look at because, again, how heavy-handed the Fed has become on the tips market may be sort of influencing inflation expectations in a way that's somewhat supportive of the mandate. Looking at the inflation swap market, we see those 10-year yields or 10-year inflation expected inflation rates back up 40 basis points month over month to 2.77%. So still moving in the wrong direction, definitely above target from the perspective of the Fed's mandate. So it's our belief that we're going to see quite a very hawkish Jay Powell, just given the dynamics we've seen, both in terms of market implied inflation expectations, but also in terms of structural inflation expectations with respect to the University of Michigan 5 to 10-year forward median inflation expectation we got a couple weeks ago, and then got the final print last Friday as well. So, and this is above and beyond all the continued acceleration, the continued thrust we're seeing in core inflation pressure. So the market, in our opinion, has gotten ahead of itself in terms of pricing in a dovish pivot, and we think this will be yet another false dawn, to borrow a quote from our friend Andy Constant over at Damp Spring. Anyway, getting into our global macro sort of tab, where we look at 300 different ETFs, roughly thereabouts, and different individual factor exposures across global macro. We sort the tab according to our odds, so we can identify what's most overbought and most oversold, with the intent of helping you, sort of structure some trades today. Nothing really overbought. That signaling a lot of China at the bottom here, Chinese utilities, Chinese energy. Chinese industrials. We talked about this stuff yesterday. We saw China. We saw a big move in China yesterday or today on the on the rumor. Someone posted on the rumor that Xi was forming a committee to sort of deal with zero COVID, and he may very well form a committee to deal with zero COVID at some point. But that rumor was not substantiated by the government. We actually saw China's vice minister or foreign ministry actually come out and confirm that they had not heard any such moves. So we know it's curious to see these sort of moves that are associated with that hold in markets. But again, this is very clearly a bear market rally that is not yet petered out from a flows perspective. So again, don't fight the tape. For those of you who remain bearish, just to wait until you get the compendium of signals here to actually to make that move. And then one final thing we call out in terms of the quarterly refunding announcement. So the market is still very much hanging on the edge of its seat, hoping that Janet Yellen, when she does the press conference tomorrow, gives them something that looks like Treasury buybacks, et cetera. It continues to be our belief, based on the recent guidance we got out of Yellen about the health of U.S. Private sector balance sheets, the strength of the economy, and the fact that market functioning is actually quite fine, relative to history outside of the most recent episode we saw in March of 2020. It's very unlikely that they're going to opt to do anything today that actually eases financial conditions and perpetuates more upside in inflation expectations. So we certainly saw with the quarterly refunding announcement a sharp uptick in the expected debt issuance. I think it was a positive revision of $150 billion. And so we're talking about a $75 billion increase in terms of the guidance for the Treasury General Account balance from today to through the end of December. And that's on top of obviously already sort of the $95 billion a month of quantitative tightening that the Fed is doing, that is going to become increasingly supported by incremental Treasury issuance. So the more the Treasury issues, the quicker the Fed can run down its balance sheet from a quantitative tightening standpoint. So net liquidity dynamics, at least up until we hear from Powell and Yellen tomorrow, thus far week to date, have actually gotten materially worse in our perspective. So if they say anything that disconfirms that, then it might be a little bit different debate. But if they say anything that does confirm this sort of adverse move we've seen from a net liquidity standpoint, and for those of you who are new, we look at net liquidity, which has become quite popular across global Wall Street, is the Fed's balance sheet minus the Treasury General Account balance minus the reverse repo facility balance. Both of those things, when they're rising, tend to drain liquidity out of the system, and vice versa. The net liquidity outlook has actually gotten worse week to date. So let's see if we follow. Let's see if Yellen and Powell follow that up with some dovish commentary or some dovish guidance. But it's our expectation that based on some of these more recent inflation dynamics from a reporting standpoint, because again, we bean count all the data that gets reported here at 42 Macro, it's unlikely that we see that outcome. So be careful there if you're putting on new longs, hoping for Powell to acquiesce to what has become quite a YOLO trade for people hoping to get back to break even by year end. So with that, Darius Dale presenting our macro minute for Tuesday, November 1st, 2022. Best of luck out there today, and catch you back here tomorrow. Cheers.